can figure that out too. Let's go down and take our required overall sales, which we know to be 30,000 units, and we're going to multiply it by the proportion of our bundle, of our typical sales package, that can be attributed to each one of those particular lines. So for salt shakers, we know that 3 out of every 5 units that we're going to sell is going to be a salt shaker. So let's take our required sales overall and multiply it by 3/5, and let's take our pepper shakers and we're going to multiply that by 2/5. And when we do, we're going to 18,000 salt shakers that we have to sell and 12,000 pepper shakers. And if you wrap your head around it for a second, it kind of makes sense. If we have to sell 30,000 units and we think 3/5 of those units that we sell are going to be salt shakers, well, that means that selling those 30,000 units is going to mean we're going to have to sell 18,000 salt shakers. And then whatever's left over, which is the 12,000 units left in the bundle, becomes our pepper shakers. So now that we have that information, we can check to make sure that we're correct by making a contribution margin income statement once again, but now we have separate columns for each product line. So for salt shakers, let's figure out our net sales revenue. And to find that, we're going to take our product sales, which is our required product sales, we just figured out, and multiply it by that particular model's sales price per unit. So for salt shakers, we need to sell 18,000 of these. And we're going to sell each one of them for $4 a piece, which means the net sales revenue that we expect to generate from salt shakers, if we do sell those 30,000 required units in total, is going to be $72,000. For pepper shakers, our required product sales were 12,000. We're selling the pepper shaker for $3.50 per unit, taken from the information, which means if that comes to fruition, if it's true, we're going to make $42,000 in sales revenue off of pepper shakers, and in total, we're going to have $114,000 in net sales revenue. For variable costs, we're going to take our required product sales for each unit again, but this time we're going to multiply it by the unit variable cost. So for salt shakers, our required sales was 18,000. If we multiply that by the variable cost for salt shakers, which is $1.50, if we make 18,000 salt shakers, it's going to cost us $27,000 to produce those. For pepper shakers, our required sales is 12,000. It also has a unit variable cost of $1.50. So if we make those 12,000 pepper shakers, it's going to cost us about $18,000 to produce those. We add that together. Given our product mix and the amount that we need to produce and sell, we're going to incur $45,000 worth of variable costs, meaning our contribution margin from salt shakers is going to be $45,000, $72,000 in sales revenue minus the $27,000 in variable costs. Our contribution margin from pepper shakers is going to be $24,000, and that is going to add up to $69,000, which is convenient because our fixed costs related to production were expected to be $69,000, which means if we do have a contribution margin of $69,000, which can go towards paying our fixed costs, and we actually have $69,000 in fixed costs, we're going to have operating income of 0. And since we were doing a break-even analysis, the amount of sales we have to have in order to break even, not make money, but not lose money, we know we're correct. So every contribution margin income statement on a break-even analysis should always end up with an operating income of 0. One last thing is the margin of safety. See, this is how much we needed to break even, but no company goes into business expecting to break even. They want to sell much more than the break-even point. And how much they expect to be above that is their safety level. So if Santori Supplies expects to have actual sales revenue of $570,000 related to these two particular models, we can throw that in as our expected sales revenue, subtract out the amount of revenue we have to have in order to break even, which we just figured out on our contribution margin income statement was $114,000, means we have $456,000 margin of safety. So our sales on salt and pepper shakers can decrease by $456,000 before we start actually losing money on the sales of these particular models. So how safe should Santori Supplies feel? Really safe. That is a big number above the required amount of break-even sales and revenue. So even if customer demand